Let's just take your temperature, Malcolm. What is your WEX word of the day? How are you seeing the markets right now?
Yeah, so my word of the day is brief, as in the current relief rally we've been seeing in the markets will be brief. I think it could last another 2 or 3 weeks as we get ready to gear up for the next Fed meeting. But I really think that as we get closer to that mid-December Fed meeting, a lot of the positive sentiment, save for the futures you just ran through, what we're looking at at the open today, will probably start to fizzle out. And I think a lot of what's already happened has been catch-up buying for investors who are looking to capture a little bit of what they missed in the first two quarters of the year with the mega cap tech trade.
All right, so you're saying it's a bit of catch-up buying. Obviously, a lot of this has been sparked by the decline in yields, giving the markets a bit of a boost. You're looking at bonds as well. What you're actually looking at is the de-inversion of the yield curve. So tell me right now in this moment, why is that so important to you?
Yeah, so it's not even necessarily the fact that we are de-inverting or uninverting or however we're technically supposed to say that. It's really how the yield curve normalizes. We really would rather have the twos come down faster than the 10 is rising. And then right now, up until, I guess, the end of last week, it looks like we were going to have the 10 rising a lot faster than the 2 was coming down, which is what we refer to as a bear steepener, which usually tells us that we're likely to have a lot more longer term pain in the markets. The recession that follows the yield curve uninverting typically lasts longer when we have that bear steepener. So we care more about how the yield curve uninverts a lot more than the fact that it does uninvert, because that pretty much is inevitable since we call it a normalized yield curve.
Okay, so that's part of your longer term outlook. As you know, right now, we really like to focus on the day ahead. So I want to also focus on another area of the market that's seen a bit of a boost since those yields fell, the Magnificent Seven. So right now, we're seeing the Magnificent Seven outperform the market. What's your view on the Magnificent Seven? I know you say there's an opportunity right now.
Mm-hmm. Yeah, I think that the Magnificent Seven is probably going to be the knee-jerk trade once again, right? There are folks who, and maybe it's the Magnificent Five at this point, right? People have kind of softened on Meta, and it looks like maybe even Nvidia. But I think the Magnificent Seven is just going to be that knee-jerk reaction trade once again, like I mentioned, the catch-up buying. I think, though, the opportunity that we've seen created is probably more in the cybersecurity landscape, where Fortinet in their soft earnings report, their soft guidance for earnings has actually created an opportunity, I think, more so for folks looking to buy inside of tech who are looking for something outside of the Magnificent Seven.
You know, speaking of Fortinet, one of the biggest laggers in the S&P, the Fortinet results that weighed on the whole cybersecurity sector actually have inspired your picks for us today. They are two ETFs, actually, the CIBR, the BUG, both of them cybersecurity ETFs. Where's the opportunity? Where are you seeing the opportunity here?
Yeah, so I think sentiment is really the issue here. So Fortinet, in my opinion, is a very specific problem. It's a very unique case, and I think that it just created contagion in the entire landscape. But if you're a person who's looking for, CrowdStrike, Palo Alto, and maybe Zscaler without having to choose the right one at the right time, something like Bug is probably your option, because I think 30% of the index, last I checked, just those three names. Or if you're a person who wants a little bit more diversified landscape to get into the cybersecurity space, CIBR is your pick, because it actually has a lot more diversified. I think it's about 30 names in the cybersecurity space that's spread across their different market caps.
Got it. I want to look ahead a little bit. I'm sure you're aware of Neil Kashkari's comments saying basically he's a bit more hawkish than a lot of people took Jay Powell's comments. What do you make of that? How do you see that weighing on the markets today?
I think that means that anybody who's anticipating December is going to be a very calm Fed meeting should at least be baking in the idea that we could get one more hike before the year is out. I think the notes from the September Fed meeting kind of laid out that they were expecting there to be one more hike before the year is out. December would be it. And so don't be surprised if we do hear a turnaround, if you will, from the Fed that goes against what the market seems to be expecting today.
Well, speaking of another hike, that would have a big impact on the housing market right now. D.R. Horton reports in probably about half an hour from right now. We had a guest on earlier, pretty bullish, $142 price target, seeing about a 25% upside. Are you bullish on the home builders right now?
I'm not, actually. I think that what's getting missed there, the housing market is very fragile right now. What's really holding it up is new home sales from people like DR Horton, for example. But what's not really being reflected there is the fact that they are buying down the interest rates to get those homes moving, and that's just not sustainable for a DR Horton or whoever else in that mid-tier market to be buying down the mortgages for the home buyers by sometimes as much as 200 basis points in order to keep from having to bring down prices. That model can't be that sustainable if rates continue to linger here like we're told they probably will, right, higher for longer, or if we get another hike that really could be the thing that breaks the housing market near term.
So what you're talking about basically is a stretched consumer. The home builders responding to the stretched consumer by buying down those mortgage rates. I want to bounce something else off of you. It's today's big consumer stat. 67%, just about 2/3 of U.S. consumers are worried about feeling financially strained this holiday season. That's according to Bank of America. Gen Zers and millennials especially concerned. How does that inform your opinion when it comes to the broader market, but obviously specifically retail?
Well, it's tough because we've been hearing that and probably saying that, answering those surveys for the better part of 6 months, maybe even a year. The consumer's stretched, the consumer's stretched. Walmart, Target has been telling us this for some time. People are trading down to the next tier product. But at the same time, the GDP report, the last GDP report, showed a 4.9% quarterly increase in spending. And so it's just tough for me to wrap my mind around a consumer that says it's concerned, that says it feels stretched, says it's having a lot of pain actually keeping track of its monthly obligations. But at the same time, we're seeing record high spending on all kinds of different entertainment options and things like that.